That's really how to solve in this current bear market. On a fundamental basis, at the end of the day, I always say never let the tail wag the dog. VC is a starting function to allow the trading of founders and give them the early risk capital. But founders and the executive teams and the CFOs are the ones who are really fundamentally driving and generating value. So if it takes on average 20 years for people to generate $1 billion company, then a primary source of capital should be private equity funds or open-ended funds. VCs that decide to be open-ended, or family offices, or government funds, or debt. Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave. Grain is an online restaurant that serves healthy yet tasty meals on demand and catering. They are backed by investors including the Lo and Behold Group, TE Tia, Open Space, and Cento Ventures. Their meals are thoughtfully created by chefs with wholesome ingredients. For the month of April, Grain has teamed up with HGH Maimuna to bring you a quirky yet delightful experience for the first ever Michelin-inspired catering in Singapore. Learn more at www.grain.com.sg. If you ever need to feed your teams or family, go check out Grain. Good morning, Adriel.
Well, good morning, Jeremy. So excited for the 8:30 a.m. breakfast show.
Yeah, so we've obviously been having a lot of fun conversations about VC returns and approaches over the past couple of years. And I think you did a great job synthesizing, I think, a certain point of view. And I wanted to take the opportunity to go through that. The context here is that people are pretty bearish on venture capital in Southeast Asia as an asset class, right? I think we felt like this many conversations that we've been part of. So I'm just not impressed on the LP side about the average return profile of funds in Southeast Asia. And I think we've definitely seen and talked to many of our peers and also our portfolio companies about what's going on. And I thought we had a certain unique point of view, and hopefully people just appreciate it as an honest conversation specifically.
Yeah, I think it's really drawing together the different beats and why people think Southeast Asia venture capital is the way it is today. I think one interesting phrase I heard was that startups had to localize their approach instead of just copy pasting the American approach in Southeast Asia. And I think consequently, I think that's also happening in the fund management space, right? Perhaps the last 10 years was sort of copy and paste of the American venture capital approach to Southeast Asia, which did not necessarily fit in perfectly. So excited to dive deeper into the different parts of it, of what could be better. And hopefully this is a sort of like constructive conversation for people thinking of deploying, but also to the founders thinking of fundraising from venture capital firms in the region.
I love what you just said, which is that it's also a function, I think, of the learning rate curves. I think for the startups, obviously, they discover much faster because their timelines are every 2 years. And I feel like we've always talked about how a VC, the learning rate for individual VCs is much slower than a founder because you have to watch multiple generations and portfolios of your VC funded companies in your portfolio go through both the boom and bust cycle. And then you kind of get to see the whole market cycle. And then you're like, okay, now I'm starting to understand it only after a certain amount of period of time.
Yeah.
And I think to double click on what you just said as well, Southeast Asia has a lot of folks who were cross-trained in the US, obviously the birthplace of venture capital, and then they moved to Southeast Asia. Now they're starting to localize to Southeast Asia. Always makes me wonder about if folks had moved from India, from China, they might have learned different lessons and brought a different flavor and approach. But I'll definitely say that venture capital in the US is very US heritage oriented in terms of how to think about exit multiples, how to think about exit outcomes, even the fund models, the LP flow of capital historically over date. And I think obviously Asia started Singapore first, which was sort of the most Americanized, I would say, maybe right there next to the Philippines there in terms of the cultural mix. So I think that's the first piece. And then obviously venture capital started to percolate into the local ecosystems, especially into Indonesia, now Vietnam. And of course, Malaysia government support. And I think Thailand and the Philippines are about one bound behind, I would say, in terms of the venture capital density stack. So on that note, I think the fundamental question that we have today is how big are exit outcomes in Southeast Asia, right? And I think the big piece is that we previously talked about this actually in prior podcast episodes, which is that we had Dimitri from Cento Ventures come, and he pretty much just spelled out, and from his perspective, I think he writes one of the best reports on Southeast Asia outcomes. I think Asia Partners also does a fantastic report. And they both actually say the same thing, but in different ways. But we are basically saying what is the optimal exit. I think that's how Asia Partners looks at it. Cento Ventures looks at it more, what is the common outcome. So it's slightly different nuanced points of view. But basically, they both kind of argue that 100 to 250 million exit is the most probable exit outcome in Southeast Asia, which is an order of magnitude lower than the American side, which is about at least $1 billion, but probably on the small side, but closer to 5 billion, all the way up to 20 billion, seen even higher, potentially coming out. So there's an order of magnitude difference between Southeast Asia outcomes and the US outcomes for exits.
So I just want to double click on that, right? What happens consequently when you're now resetting to, as a fund manager, looking at a startup as a potential $100 to $250 million exit outcome instead of a large multi-billion-dollar IPO? How does that consequently affect deployment, fund strategy?
Yeah, I mean, the truth is that the US approach classically is that out of a portfolio of 20 companies, one company would be $1 billion IPO, and not just 1 billion these days, but you can see 2 bill, 5 bill, 10 bill. And so if you have that projection, then the classic approach is that 19 out of 20 of your portfolios can be effectively lose all your money, maybe out of that 3, maybe return your capital or have a small exit outcome. But really fundamentally is one of them will drive that outcome, right? And so the truth of the matter is that if you look at the average US, I've often said about this number, about 1 in 40 seed funded startups will eventually become a unicorn. And so an above average VC fund means 50% or above will have at least one unicorn in the portfolio. And then the bottom 50% will have no unicorn in their portfolio. And as a result, you could have 20% net IRR plus when you're above average. And if you're below average, then you're effectively at 0 or worse. And I think that changes the fund approach, which I think we want to discuss further. But I do also want to quickly caveat and say, why is this happening? And one part of it is that Southeast Asia is an emerging market. So obviously there's some structural differences where one is it's earlier in ecosystem. 2 is the overall economic growth is slower than that of, for example, China. 3 is the markets are subdivided into 6 different markets, all of different sizes, different market conditions, different cultures. And so it's not easy to scale across multiple countries the same way it would be to scale within China under one regulator, under the US, under one common market. Obviously the US market is at 90,000 GDP per capita. China is growing at 7 to 10% historically in terms of the GDP per capita. So it's a different approach that they had. And then lastly, of course, is that the capital markets are very structured very differently, right? So the US, there's the US stock exchange to go through. China still has Hong Kong and historically access to the US. India has access to the India stock market. And then when we're going to Southeast Asia, then Singapore Stock Exchange historically doesn't allow loss-making companies to go public, which means it disqualifies, as you can imagine, all of the US type of IPOs where it is still losing money that wouldn't have been allowed to list in the Singapore Stock Exchange. You have the Thai Stock Exchange, and then you have the Japan Stock Exchange, and then you have the Indonesia Stock Exchanges, which are all doable. I think they're all relatively well run, have enough capitals for, again, $100 million exit. But then again, you start to have this dynamic where companies are having to hit this dynamic where it's just harder to build out that company that's large enough for $1 billion company. And then they can't list because they're burning money after that stage using an American approach. And so I think it's structurally harder. So that's why I think Dimitri was kind of saying that in the episode. Asia Partners also talks about why they're trying to build rhinoceroses, which is companies that are about $100 million mark. They are able to list on local stock exchanges. They don't fully push for their portfolio companies to go for $1 billion loss-making tempo exit in the US market. So I think that's a really key piece. Obviously, that's important if you're a founder in terms of your exit outcome. Also, of course, now kind of circling back to your question as a result is you're not a VC fund that's like saying, oh, we're a pessimist and we don't want our companies to go for $1 billion exit. What we're just saying is that the odds is not necessarily 1 in 40. And if you're above average, you're 1 in 20. What if the ecosystem is 3 times harder on average? So it's 1 out of 120, right? Or if you're pessimist, truly, then maybe it's 10 times harder. So if you're 1 out of 200 portfolio, and then as a result, we're not saying that you can't be a high performing fund, but then basically what we're saying is that instead of being above average as a VC, in order for you to generate returns that are similar to an American style VC, competing with American style capital, looking for American style returns, then you need to be a top 10% fund. Maybe you need to be a top 1% fund that are able to generate those returns. But I think that pushes us VCs as a result that when you're a fund strategy, you still probably can, to answer your question, still set your target about having a 1 in 20 strategy. But if that's your approach, then I think you have to be much more disciplined. I think you have to be 3 times either smarter, wiser, more helpful, or even maybe cheaper in terms of your deal terms or in terms of your conservatism versus an American counterpart to realize the same returns. And again, if you're a bear, then maybe 10 times more. And I think that's where I think folks like having that strategic gap in that sense, which is I want the VC style portfolio approach with VC style culture of the US, assuming that Southeast Asia has a US capital exit structure. And then that breaks down very quickly because once you have that fundamental gap of that reality, then you can't dice those returns and then your strategy kind of falls apart, which I think what's happening now today is I think everybody's starting to recycle that learning loop now in Southeast Asia.
Yeah, so I want to double click into what you said about multiples. I think that's a big topic. When I go to the US, I ask some of my VC friends there, hey, how do you pay 40, 50 mil post money at effectively sub 1 mil revenues, right? Because Southeast Asia venture rarely underwrite at those sort of multiples. The multiples at Southeast Asia VCs are more used to underwriting things at 10 to 20x. But I think when you start to look at what the US stock exchanges are trading at, I think there's been different reports about how the median outcome or median PE for, say, the Magnificent 7 for the S&P 500 is roughly about 65x PE. And then when you look at what the local stock exchanges in Southeast Asia, whether it's KL, Bangkok, effectively one or two magnitudes lower than that. So curious to hear your thoughts on how should we think about multiples and how that's an implication there.
The truth of the matter is that it's really a function of the US rather than a function of like individual stock exchanges not performing well, because the US really has that density of capital. They're the retail investors. They are the richest country in the world for now. And then you have all this liquid wealth, obviously, that's there, and they still have that wealth on a per capita basis. So imagine that the US stock exchange as a result is hugely supported by not just the global institutions, but also retail investors with a lot of capital who are investing in ETFs and the overall stock market. So basically what you're having is that this vortex of capital is basically sucking up more and more capital from the rest of the world. And so everybody who wants to list globally would pretty much list in the US stock exchanges, the New York Stock Exchange or NASDAQ, because a Japanese institution can trade on a NASDAQ easily, but it may be hard for them to access a Japanese retail investor to access the Singapore Stock Exchange, for example, because you don't have the same market coverage, you don't have the same trading tools, and so on and so forth. So I think we just had to realize as a result that it's very understandable. And I think a lot of founders get very surprised because they're like, hey, I raised my Series A, they want to push me towards a US IPO. What does that mean? But then, of course, it's that if you are a Vietnamese company and then you're trying to list on the US IPO, then suddenly you also have some structural disadvantages that we saw for both Grab as well as C Group. And so for them, they both listed in the New York Stock Exchange as well as the NASDAQ individually, one through SPAC and one through a traditional IPO. And what both of them discovered, of course, is that one is that as a company, when you're building from anywhere in the world, again, this is not a Singapore or Southeast Asia problem, but an emerging markets problem. But imagine that you have to build out a great CFO who's able to understand not just local markets, but also has a trust of a Wall Street. Then you need to get initiating coverage from all the analysts. And then your CEO needs to spend a lot of time talking to all of them. And a lot of the volume is being done by large institutions because they decide what goes into the ETFs. They decide what goes into what they recommend to buy or sell or hold. And so it's actually a very different muscle because suddenly you're tapping basically public market expertise that is hard to exist. Even in Singapore, primarily they are in New York, not even in SF to some extent. And then suddenly you need to have the expertise, be able to talk about Indonesia, Vietnamese market. So that's one angle of it. But you can imagine the other side of it, which is that you're a retail investor in the US and then you don't understand Grab. You don't understand C Group because you don't understand Asia. So it's hard for you to get bullish. Whereas I remember I was taking a bus all the way back in 2012, I think. And I remember I was talking to this guy from the Sierra Club. So he's an environmental guy. He's in San Francisco. I was taking a bus with him in hiking the Pacific Crest Trail. And this was about, 2015 as well. It was around that time frame, 2012, 2015. And he was just talking to me about this stock called Tesla. I remember he was just chatting about the world. He's Jeremy, I'm so passionate about Tesla because I'm the chapter head of the Sierra Club and it's going to save the world. But this guy's a great engineer. I understand this because I was a former engineer at Ford. And then I was like this noob university student. I was like, oh, I never heard of Tesla. Electric vehicles seem very far away, very sci-fi. And this guy was like, I'm all in. I'm putting all my money in. It's a good cause. And so there's a lot of retail YOLO in some extent, but that's going to be some of the necessary uplift that you need to have in order to have a great IPO rally and so forth. So that IPO pop, that rally is really key because then you start working backwards a little bit, which is that if you know that there's going to be a high IPO price to earnings ratio multiple in the markets, which is valuing you at a high multiple, even though you're losing money on a net basis, right? Because the US market is able to be bullish enough to underwrite your losses in the short term in the belief of future expectations, which is a behavior that we don't really see in Southeast Asia retail investors or institutions. Then you can work backwards a little bit, which is that your late stage capital, your crossover funds from PE funds from the IPO stage to your late stage private equity funds can, as a result, have higher multiples in the expectation they can go there. And then your middle stage funds can have the expectation to have high multiples. And then your early stage people can have expectations of high multiples. And then they can themselves themselves can give high multiples. So you kind of work your way through. So the question is like, why aren't Southeast Asian? I always remember those founders was like, Jeremy, Southeast Asian VCs are so cheap. And it was like a negative way of saying it. It was like, you guys are just so cheap. And then versus American VCs, they're paying so much better. And I think part of it is obviously structural in the sense that Southeast Asian VCs have less LP capital than the US. But also, I think is a realization that the enterprise value multiples are also an order of magnitude lower for, again, the ecosystem pathing of the difficulty of Southeast Asian startups, which I think American VC funds do not necessarily understand when they're meeting a Southeast Asian founder, very American trained, American educated. So during the Zoom times, a lot of folks raise a lot of capital from US funds because this person looks like me, talks like me, but happens to be raising only at a 20x multiple when, remember, the top of the market, they were paying 100x multiple. And so they were like, wow, I was talking to American VC friends and they were like, wow, Southeast Asia is cheap. Zero interest rate policy has not trickled into Southeast Asia. It's a 5x cheaper from 100x to 20x, and then they were just paying. And the awkward reality now is that a lot of those stories have not panned out, unfortunately, and they're never going to pan out. And now obviously we see the compression where US VCs, if they're investing in Southeast Asia, is an order of magnitude lower. And even Southeast Asian VCs, I think you mentioned 10 to 20x. I think you can probably see 5x in the Southeast Asian side as well. And so I think there's this dynamic where the public exit multiple and what they're willing to bear and the quantum and magnitude of that exchange market size exit ripples into a late stage, the middle stage, ripples to the early stage. And I think that took some time to percolate through the system.
You know, I was in Hong Kong recently and just hanging out with some of my private equity friends. And they always tell me, like, I don't understand venture capital because in private equity, they can lever up with that when they do their buyouts and they bank on multiple expansion, right? Which means they come in really cheap at a really cheap multiple and they basically underwrite that the multiple for this category or company will expand down the road. But in venture, the early stage guys are like underwriting at large multiples, and you know that multiple just keeps getting compressed across your seed, Series A, all the way to your growth stage, and then eventually, if an IPO happens, it's like way tighter than what your early investors underwrote it at. How do you think about that?
I mean, that's entirely spot on, right? And if you look at it from a historical basis, it makes sense, right? So you have VC funds that are very American-centric in terms of their initial approach. And a lot of them were investing in Singapore startups, right? Which tend to be much more globalized. Singapore's GDP per capita is effectively the same as the US. There's a lot of deep tech. And so the early under type of startups, so initially underwritten to some extent, it felt like it made sense because you have similar strategy investing in, to some extent, like very R&D centric moonshot kind of startups, I think. So I think the early stage, the higher multiple relatively, because you just got to start somewhere. Obviously not as high as the US, but relatively high. And then the middle stage said, I can believe in this story as well. Let's underwrite that. And I think more importantly, the zero interest rate policy era came just nicely from this time period for the middle stage, your Series B and your late stage, especially the massive printing of 2021, 2022, the pandemic era. There were a lot of tourist US funds that were entering and they created a lot of coverage for what we commonly call today the Series B, the Valley of Death in Southeast Asia, which more like not just valley, I think, because it implies that you get out of the valley. Right? So it's just like a cliff, fell off a cliff, and then you're just like struggling for 2 or 3 rounds. And then if you manage to make it to a stock exchange, then you can't get there. So it's more like, I think valley is optimistic in that sense. And then I think what happened was that as companies start to fall off that cliff over time, then all the early stage VCs are looking at it and like, oh, okay, this was a great founder. And then obviously, we also saw different types of companies being underwritten. So less pure play. For example, we saw Traveloka, Gojek, Grab. These are all relatively pure play digital, primarily, obviously, with a very strong logistics piece and travel piece and all these other dynamics. But I think we started to see also the expansion to like very deep into the Indonesian economy, the Vietnamese economy. And these have a GDP of capita, which are 10x lower than Singapore, right? And 10x lower than America, right? And then again, their market size is not as big as India, even though they're similar GDP per capita. They don't have the same growth rate as China, right? Which kind of doubled their economy pretty much across the decade plus. So when you don't have these factors, then suddenly you're also underwriting a different type. So your initial pool of capital is underwriting a very small pool that will kind of look more American type of startups. And then you make this assumption about American style strategy. And then suddenly you're underwriting a different startup pool with that are more embedded into the regional economies, and you're starting to watch these people fall off. And I think that's where your margin compression starts to happen. And so I think what's happening now is there's a period where there was relatively high multiples in that sense, and then it got hot because the late stage came in and started people in Southeast Asia started writing higher early stage multiples. And then now that the bear market is happening and most of them are gone now from the US side. And now suddenly middle stage are starting to realize that, then the early stage folks are starting to realize that. So everything's starting to recompress down as well. So I think people are like, how do we fill up the cliff and build another mountain to make it a flat thing? And I'm like, I think most people are kind of like lowering the height of this thing. So it's still a drop off, but maybe a more gradual drop off. So that's what we're seeing.
I think you talk about this quite frequently within OVO as well, right? Which is that there's essentially two kinds of economies in Southeast Asia that we are investing in, and then each type of economy requires its own nuance and evaluating the startup, the multiples, how we think about their go-to-market product, hiring strategy, and all that. Do you want to elaborate more on that?
Yeah, and this will be coming in a brief episode that we'll hyperlink in this once it comes out as well. But I think the one angle about it is really GDP per capita, right? And I mentioned this earlier. So the US is about 90,000 GDP per capita. Obviously, San Francisco as a city and New York as a city are actually both multiples higher of that on the city GDP per capita. So Singapore's GDP per capita is effectively the same as America, 90,000 GDP per capita. Of course, Singapore is a city, right? So the volume is 300 million people of this thing versus Singapore is at 5 million effectively on a consumer basis. And then suddenly you go to the next bound, which is you look at Malaysia and Thailand, which is around 15,000 GDP per capita. And then you have the rest of Southeast Asia, which is Indonesia, Philippines, and Vietnam, which is about half of that of Malaysia and Thailand, which is around the 7 to 9,000 GDP per capita. And of course, these are larger populations as well, actually. So there's an interesting, can imagine like this two diagonal lines, right? It's like the countries that have the highest GDP per capita are very small, and the ones that have lower GDP per capita currently have larger populations. And so I think this is interesting dynamic as a result, which is that when you're building for your domestic country versus are you building for the US, right? So actually we see this in India, right? There's a lot of SaaS founders who are saying, I'm not building for India because India's GDP per capita is similar to that of Indonesia, Vietnam, Philippines. So the Indian founders are also separating two tracks. One is I want to sell to my local. So we're doing like quick commerce, which is another thing altogether. But some level of e-commerce, which is embedded, local financing, working loans. So there's all kinds of local stuff they're doing. And then the other part that they're doing is I want to build SaaS for America because I have an Indian diaspora, I have an Indian engineering team that has worked previously for American SaaS companies. And now that accelerators and VC funds they literally have big VC funds that I won't mention, but they literally have offices, one in India, one in SF, and one in New York. And then they train them as like, we're going to train you how to sell, then we'll bring you there, and then we'll shop you to the US VCs who understand SaaS multiples, but also shop you to the US potential customers, because then suddenly you have this dynamic where you're paying Indian level wages or emerging market wages versus a US price point. And we also kind of see that actually for a lot of the Chinese companies today, which is that they're expanding to US because you look at e-commerce folks like Temu and Shane. From their perspective, is historically we've been fighting for the Chinese market, which is very low pricing power because of the GDP per capita, even for them. And it's also highly competitive and cannibalistic as a market. But we have the Chinese cost structure, which is the white label, the manufacturing, the logistics chain. And they're like, wait, I can go to America and pay 10x, and then I can give this massive discount off the Amazon market structure. And then suddenly they can exit. And so the e-commerce players in China are doing what the Indian SaaS folks are doing, which is they're trying to take advantage of that arbitrage or that multiple difference on the pricing power side versus the cost structure side. And so I think in Southeast Asia, as a result, we see two types of companies that are, for example, we see this for the Singaporean folks who are or who are very American-centric in many ways. So they tend to build American-style companies of the institutions. And then we see this obviously for the US-educated Southeast Asians, so US-educated Vietnamese folks, US-educated Filipinos and Indonesians. So they're also building for the US market at some level. They're just using that structure. I think Athena is a great example. So they're doing electronic assistance, right? And so what they're doing on one level is they're using Filipino EAs, and then they're kind of like using some level of organization, but they're selling to American executives who want an executive assistant, right? And so they're taking that. I think we see that for call centers as well. Why have American call centers for American customers when you have Southeast Asian or Filipino call centers as well? Versus, I think if you're building for your Indonesian real economy, then suddenly you're building cold chain for Indonesia, which we've invested in. We're also looking at chicken farming, right? It's as brick and mortar as local as you can. It's Indonesian chickens for Indonesian consumers, which we have also invested in. And so I think that's really that crux, which is that suddenly you have that bifurcation of type of companies. And in the episode that we're going to link to as well, we'll talk about the other different categories and niches of this that's important. But I think those are the major clusters. I forgot to mention I think there's also a lot of diaspora floating around Thailand, the Philippines, the Chinese, the Russians, the whoever's. But, basically they have a global European mindset, for example. Some of them are going to tackle, I think we've seen them tackle the local market. and they tend to ally with a local founder. And then some of them are really going to start tackling the global, the home markets, right? The European market. So I think you see a lot of crypto folks, they're all at Bali or whatever, and they're like, okay, I'm servicing crypto. I can't do this in my country because it's banned or it's too dangerous, but I can do this from Singapore or Bali. So I think those are the bifurcations, I would say, in terms of company build outs, but as a result, multiple / approaches that they have.
I think your American offshoring example ties in very nicely to the next point, which is really an elephant in the room, right? The traditional economic arbitrage is, hey, I'm an American company selling like things at $100 to the consumers. I want to grow my top line, but at the same time, I also want to reduce my cost structures over time. And I do that through hiring cheaper labor, often in an emerging market. And that's how your profit margin massively over time. But in Southeast Asia, yes, there's that attempt to grow your top line. But at the same time, people are also increasing their cost structure, right? Like people are importing expensive talent to solve oftentimes cheap problems. And I think that's also why we have seen a lot of companies fail to go on that path to profitability, right? How has that manifested in your?
I think there's 100 spot on, and I think credit goes to you for saying it. You sent it on the WhatsApp, and I saw that and I laughed because you call it reverse economic arbitrage. I don't know what the right phrase is. I'm sure there's a catchier one because reverse economic arbitrage is not the right phrase yet. I don't think it's the right way to capture it, but I thought it was like really spot on because like the reason, people always like, okay, why did America experience high growth and low inflation? And then they're like, basically it's like Walmart was basically like selling these really cheap clothes, and then it got cheaper and cheaper, right, over time. And then Walmart grew huge. And it's like, because Chinese manufacturers were making this t-shirt cheaper and cheaper. And so you sell at American prices, and then you kind of have this giant Chinese manufacturing machine getting cheaper and smarter. And obviously trade sanctions have broken this relationship. So all these Chinese manufacturers are going to sell to Thermo, who's going to go direct to consumer in America, and then inflation is going up and blah, blah, blah. So, but that's like the fundamental rule of economics, which is like comparative advantages, is that some countries are better at some things and some countries are better at other things. So how do you play to your strengths? Because even though America is more expensive, America is really good at R&D. It's very good at space rockets. It's very good at all these things. And so they can do it cheaper. They can do a cheaper space rocket than somebody else can do it. They can do a cheaper semiconductor designing than somebody else. They can do cheaper product design because it's all about the ratio of that versus the ratio of that. And I think one of the shame of the decoupling of the US-China side, obviously, is that suddenly China is starting to say, oh shit, I need to learn all this stuff. I need to learn how to do rockets. I need to learn to do manufacturing. And honestly, I think there's bad news for America. But there's going to be another future episode, right? But I think the reason why I say this is that this is a very important economic concept, because suddenly when we're talking about Southeast Asia, I think we've seen that happen actually multiple times now, where US MNCs are fighting to enter Southeast Asia. So we saw that with Uber. I think we saw that with Rocket Internet. And a lot of them obviously were hiring executives that were primarily expatriate or US educated, which obviously, and I would say maybe to some extent, also a bit Singapore centric as a result. And so all those things kind of made these cost structures fundamentally, in some ways, more expensive, obviously on a per person basis. And then two is that a little bit less responsive, I would say, to the local markets, because it depends. For Grab and Gojek, both outcompeted Uber, right? Grab was faster, more understanding the local market than Uber. So Uber got outcompeted, even though it had a head start in terms of technology stack, capital stack, all that stuff. So sorry, but Uber lost fundamentally. And Singapore was and continues to be the most important profitable market that's really key to play here. That's one. But on the other side that we have here is that Uber lost or choose to lose to Gojek, which also kind of makes sense also because Indonesia as a market is very expensive. But what I'm trying to say is, but then of course, why did Uber choose to leave Gojek's? Because the cost structure fundamentally was going to be more expensive than Gojek was hiring locally, but also using Gojek's, right? The local motorcycle taxis to do it, which is a lower cost structure, low commission, but also honestly a better experience. Not necessarily a safer one, but faster experience at time. And so that's the piece where, as a result, you're using expensive labor that's not in touch and high velocity to tackle local problems. And kind of goes back to the earlier point, which is as a founder or VC who's on a board, the question then as a result is, are you pushing for the same outcome as the US? Do you believe that? Or do you believe it's a lower outcome? Because I think this is where we're kind of saying here is it's not wrong to hire American style executives and have American style VC board strategy if you believe outcomes are going to be American style. Because then you're like, look, it's also going to be a $10 billion outcome and you'll still be able to exit a New York Stock Exchange on a loss-making basis. So we might as well hire the same type of talent, and that talent understands the strategy way better than the local folks. And I think what we've started to realize is that almost every startup since then, I mean, obviously they continue to draw from alumni, from the Rocket and the Uber folks, and they're still around. But I think you see that bifurcation. I think folks are either going into the global SaaS piece, right? Because they're saying they're comfortable with that. But I think what we see as well is maybe they become executives, but then the team is very local. And I think we've seen, I won't mention, but there was a Chinese founder that we met, and then their first company they had was primarily Chinese executives, Chinese operators. And then that didn't work out because even the cost structure of the Chinese folks was too high for the Indonesia market. And so the next startup they had to do was using more local folks rather than Chinese folks. So think about it.
Yeah.
The Chinese executives being transferred from China is too expensive for the Indonesian market, right? So how can you even do that for German or European or American style talent, right? So it doesn't even work. And then also, I'll say one other aspect about it as well is that this plays into the single country versus the multi-country strategy as well, which is a single country, it's a single tax code, single financial code, single market. To some extent, there is economies of scale in terms of scaling operations. Obviously, in Indonesia, tier 1 city, tier 2, tier 3, Dangangan, Ryan Manefe, and Wilson in the previous podcast episodes that we'll hyperlink to explain this pretty well. Obviously, they're like still worlds apart, to be honest, in terms of GDP per capita and structure and infrastructure. Yeah. But at least from a labor perspective, somebody from Jakarta can be like, I can be the expansion team. But I think if you think about that jump from Singapore to Jakarta expansion, then can that Singaporean or American or European or Chinese person actually be able to do the expansion? Yeah. Well, I would say that it's not that they can't do it, but like the ease of Jakarta tier 1 to tier 2 to tier 3 is way easier compared to market expansion from Singapore to KL to Ho Chi Minh City. So those 3 jumps are just fundamentally way harder. But of course, I'll tell you this from a flag perspective on the VC slide is way sexier to be, like Singapore, KL. I mean, people don't even want to do Singapore, KL. People are like, oh, KL is like Singapore, Jakarta, Ho Chi Minh City, Manila. Like that's a sexier path. Whereas I think you can probably make an argument maybe Singapore, KL, Bangkok feels a little bit more rational, I would say, from a capital city. Or you can even say Singapore, Hong Kong, Tokyo, Seoul, feels like a more rational GDP per capita, cultural similarity, market structure, government approach. But from a flag perspective, it always looks sexier to be like, put those flags on the slide deck on the go-to-market / usage of funds slide.
I think that's so spot on, right, Rich? Is the country that you're expanding into worth it to hire another whole like country executive team layer, GM, CFO, and that hinders the path to profitability, right? Imagine if you're now trying to do like a shallow regional play, how you have to hire 5 country GMs, 5 more CFOs. Like, how do you even break even on that before your next round, right? Whereas if you go deeper locally, that generate those massive economies of scale on the G&A piece.
And I think it's spot on. I think one example of that is a lot of SaaS founders, for example, in Singapore, they're building, and then they try to go to Indonesia, and then they're like, oh shit, like nobody wants to buy SaaS, right? And it's hard to buy SaaS. And the reason why we talked about is that the SaaS fundamentally is about replacing labor, right? So I'm willing to pay a subscription because it helps me save time. So I'm doing financial accounting. I have a pay for SaaS. I pay $50 a month, right? Let's say $100 per month, because it saves me the cost of one Singaporean accountant, which just cost me $90,000 GDP per capita. So it's I pay $1,000 on a year basis. I save $90,000. Yeah. Whereas if your cost of labor this is what we see is like Malaysia and Thailand is $15,000, then the trade-off is doable, but it's still a trade, right? Which clusters, which industries make sense. And then if you're going to Indonesia, which is again another order of magnitude smaller, we talked about it earlier, then people are like, hey, I can hire people, interns or university students to cover that, right? And so a lot of SaaS folks are like, okay, I want to serve this region. And then that's where they kind of run the problems, because they start building a GM in Indonesia, then they realize they don't have the same profit margins, and then they either have to cut costs, and then they have to lower the price a lot, and then use it more as a flag, but also hopefully the market improves over time, which is a very long, expensive play. They choose to exit the market. And I think, of course, people say product-led growth, which also doesn't really work as well. Product-led growth only works in high GDP per capita countries, really fundamentally, right? Here.
So the TLDR is that all the American truisms on startup and venture capital just spun in Southeast Asia.
Yeah. It's like watch YC videos and then go watch Brave videos, maybe. But I think we don't do a good job, actually. I think we do a good job talking about it if you listen to every cast. And then every founder kind of says the same stuff, which is like PLG didn't work for us. Enterprise sales is about cost of labor. So I think if you listen to all of it and you're like kind of like really thoughtful and talking about these dinner conversations we're having, you stitch it together, you understand what's wrong with some of the YC slash Silicon Valley truisms. But then, of course, I think one of the things that we're going to do in the future is, and then this conversation is one of them, is I think we've got to be a bit more explicit about that the US logic makes sense. And I think, for example, the YC video still makes sense if you're in Singapore or Phuket or Jakarta or Manila and you're building for the US market. I think it still works. But if you're building for the local market, which is an order of magnitude lower GDP per capita and with fundamental infrastructure gaps on that ladder, then I think things start to fall apart, especially on the fundraising side as well.
Yeah. So what you basically just about is, the first part of, I guess, possible solutions in Southeast Asia when we think about what went wrong over the last 10 years, right? What other solutions or what are things we consequently adapt when we think about venture capital in the region?
Yeah, I mean, you just reminded me that we did sound very bearish. But again, we want to kind of clarify that if you're a company going after the US, you still can go through the US style approach, US fund returns. So that's one. But of course, being honest about, and I think Dimitri said, if your revenues are coming from Southeast Asia, then you got to be aware about those exit outcomes. So being honest. I think the second part that we'll be thoughtful about is being very thoughtful about the risk versus reward structure as a result of your company exit outcomes, both from a founder perspective, but also from a VC perspective, right? So I think from a founder perspective, like I said, there's nothing wrong using expensive Western labor if you're going after a Western problem, right? And then you feel free to just use Zoom and hybrid to lower your cost structure the way you want. But I think that if you're building a company that's going after a domestic problem because you care about it, you're a patriot of your country, you want to work in your local market, then you can, but you just have to be aware that the exit outcomes of the companies that have there, and I think that's where you look at the Chinese stories, you look at the Chinese Indian stories as well, and some of the explosions, but also some of their success stories about why they're much more capital efficient and why much hungrier than their American counterparts or even the European counterparts. And so what I'm trying to say here is that if you know that exit outcomes are order smaller, then it changes how you fundraise, right? Which is that one is, I think that you're much more disciplined about your fundraise, right? So fundraising maybe smaller quantums at more disciplined valuations because you want to preserve your ownership. That's one aspect. Or the other way is that you honestly structure yourself more for a private equity kind of outcome. So you're taking on friends and family capital, some early stage capital, but you're basically telling them, look, my outcome is 100 mil. I'm going to do a trade sale. And so as a result, there's you can call it conservative by historical standards, but I would say very prudent and wise capital deployment, very, very disciplined about structure. And we saw that, for example, in our company like Basket, which is doing Indonesian supply chain. So one of the things that we said, hey, so many supply chain companies have failed. And what's your key takeaway? And he was like, I got to be way more conservative on my cash flow than other people. And so I think structuring your mindset to have that structure opens up some new opportunities. So I was talking with a B2B marketplaces company, and one of the key structures that they always have is, hey, when you are in a low GDP per capita country, your customers are very budget conscious and your suppliers are not very efficient or effective and not able to adapt, right? And so the classic B2B marketplace is saying, I'm going to charge suppliers a fee for accessing buyers. Doesn't really work out because they don't have the capital or margin structure. Or we are going to convert our suppliers to improve their efficiencies, and then they're going to give me a percentage of that upside to pay me, which doesn't really happen either because everybody's too staffed. But then if you look at it from a private equity perspective, then you're saying like, look, why don't you buy out one of the suppliers, right? And run that company, because you're saying that, and this is where the thing about it from a private equity kind of play comes in, and we talked about this small cap private equity kind of sharpen up, is even though as a VC you have lower multiples, but there are also low multiples for buying a factory, right? Even lower multiples. And so if you're able to access debt or equity that we talked about, you mentioned about private equity funds being able to access debt for leverage, for example, there's no reason to stop a decent local executive or founder to access debt as well if you have the right connections, the right approach. But also the right promise, the bank that you're not running a giant net loss every year, because the bank will definitely say nope. But if you're able to build that profitable company that has that profitable set of revenues, then the banks are able to lend you money. And then that's when you can start to snowball that set to have private equity outcomes. But then, of course, when you start doing that, then of course the bad news for the VCs is that then founders will say, okay, I can pay myself cash flow and salaries, and I don't necessarily need to achieve that public market exit in 10 years. And this is where I think the tricky part for VCs are, which is that if you are trying to go for a public market exit in 10 years because you have a fund promise within 10 years, that's the tricky part suddenly all of a sudden, right? Because if your founders are going to go for a private equity piece because they're basically saying, okay, I still want to be $1 billion company. I want to do this over 20 years and I want to use a mixture of debt and equity and I'm willing to be profitable at each stage of it, then I think VC funds have a bunch of different strategies, right? One is they can go earlier where there's still a VC type of outcome, but obviously you need to have a longer time horizon. So maybe a family office to some extent, or you start, I think you see some funds in emerging markets becoming open-ended funds. So basically it's a perpetual fund. So they don't have to exit within 10 years. So the paper returns continue to go up. I think the other way that you can potentially do it is you focus on US style companies that still have that US type of return profile underlooked by the Southeast Asia market. And so I think there's one other angle of it. Or you just say, hey, I'm actually a small cap private equity shop. And that's what you promise to a lot of LPs. And I think actually a lot of VC funds we know actually have made that discussion already with LPs, which is, hey, we're actually going to converge closer to small cap private equity in terms of the type of companies that we want to fund or invest. But that also changes your portfolio mix, because instead of having one super high return $10 billion exit on the US stock exchange, the rest being like not returning capital, if actually losing money. And suddenly you look small cap PE, maybe it looks like 10, 9, 1. I mean, I don't know what the right answer is for the right mix, because people don't really know. But I think that's where I think people have to fundamentally relook at their fund structure and their fund model at a very different way. So, and I think that's hard, because suddenly you have you suddenly have founders who are like, hey, if I build this in a private equity way, I don't need to exit. I can just pay myself couple $100,000, live like a king, have benefits, and I don't ever need to exit. And then you suddenly have VC funds who have a minority ownership of these companies, and then they can't get out because they can only get out through secondaries. And today's market, secondaries are being traded for at least 50% off, if not 60, 70% discount, which is a horrible way to exit, because again, it's there's liquidity for those trades, but also there's not enough buyers who understand Southeast Asia as a market. So hopefully maybe the ecosystem gets better over time. So I think there's one angle of it. And I think that's where the private equity approaches buying at least a 51% hold in a company means that you have the board rights to say, okay, either I push the company for that higher growth IPO route still because I don't want them to slow down, or I can replace the CEO if they want to slow down. They push them to go for a private equity trade sale, which is still doable. So they can not force, I mean, they're the owners anyway, right? So they can sell it to another private equity fund that sees that global opportunity. So private equity companies are a little bit more globally thoughtful, I would say, and acquirer friendly. You could sell to a corporate strategic acquirer still as well, because you have the ability to pull that trigger. Or I think I've seen some private equity funds, I was just like, look, we can't sell right now, it's bear market, but let's just hold the asset. We have 51%, 75%, 100%. Let's just hold the asset and just get cash, and let's lever in more debt to unlock value from assets, and we use that to buy another asset. We roll up and we go buy another asset and roll it up. And so there's a lot of different ways that a private equity player with majority control. And again, what I'm trying to say is that you saw a lot of those measures actually are what founders can do. Founders can also roll up and use that cash to buy other companies. They themselves can also sell to a strategic acquirer or sell to a PE shop. But then of course, is if you diluted yourself like crazy in the early years and you split it like crazy because you were like spending like crazy, then obviously then suddenly these private equity outcomes look terrible to you, because suddenly you look like you made yourself $1 billion, but it took you 20 years to get there on your stock outcomes. So that can break down pretty quickly.
I mean, I think there's so many good points that you mentioned there, right? Raising M&As, which actually it's a great time to do it, given how a lot of companies are struggling to fundraise. I think this is a time where strong companies and strong teams can raise money to go and buy out and consolidate, which then leads to some level of vertical integration and better margin structure. I think there's also another interesting piece about how do you as a fund make your entry price sort of lower as a function of de-risking the investment. We talked about like how private equity does leverage, but I think what we're starting to see as well is that people are doing more secondary transactions. I think that was historically very, condemned. Or there was like,
you don't believe in your founder.
like some level of taboo, right? But the truth is that it's a win situation for a lot of parties here. I think for early investors, it's great because they are quick liquid. And the sort of return profile for early investors might just be like a 2-3x and they are happy to call it a day. Whereas your funds need a much higher return profile because, they have certain, fund models and strategies. But that for the person buying it, they come in at a much lower price because of the secondaries. And then for the founders, they're going to clean up their cap table. They're going to bring in more helpful and strategic capital. So what do you think about enabling secondaries transactions? What's the state of the market on that?
I mean, I have mixed feelings about that, but because I think it's true that from a tactical basis, as a VC fund, you need to realize returns, right? So realizing 2 to 3x returns within 4 years, it's actually really good because basically you're realizing your 20, 30% IRR at least. You're able to do that. And you don't need to unlock 10x, for example, or 100x, right? So I think there's that shape or the convexity of your curve is really important. And this obviously applies to fundraising and margins compression, but also I think secondary transactions as well. And you don't want to be in a situation on the other end scale where you say you have a 10-year fund and then because you are a closed fund where you have to finish within 10 years, then you're forced to sell at year 10 effectively, or ask permission from your LPs to extend your fund life. And then the secondary buyers kind of know you have to sell. And then you're in a deep bad position, especially because you happen to sell during a bear market or a flat market rather than a bull market. So to some extent, if you're able to be smart and you sold during the bull market, you get optionality, I think there's this technical piece that I think funds, everybody's doing, right? And so I think every fund has started hiring a corp dev person to help them figure out the transactions. But also I think we're starting to see, I think the converse of that is I think we're starting to see more secondaries funds being launched in Southeast Asia. I think we also see some Hong Kong or Chinese secondary funds also starting to explore the Southeast Asia market. Again, I think it's family offices. It could be a good asset for family offices to hold because they don't have a fund life requirement of 10 years because they can hold forever, right? Multi-generational asset. And I think we also see, I think the entry of like private debt companies as well, because Heliconia, for example, they're structuring debt because they see that opportunity. Again, the sophistication of your VCs and to allow that on a board, but also to allow the CFOs who have the ability to understand debt is there. So I think the tactical side, I think I agree with you. I think that's really how to solve that in this current bear market. It's just that I think on a fundamental basis, at the end of the day, I always say never let the tail wag the dog. VC is a starting function to allow the trading of founders and give them the early risk capital. But founders and the executive teams and the CFOs are the ones who are really fundamentally driving and generating value, right? If that makes sense. So if it takes on average 20 years for people to generate $1 billion company, then a primary source of capital should be private equity funds or open-ended funds that are like VCs that decide to be open-ended, or family offices or government funds or debt, right? I mean, these are all like, so what I'm trying to say here is, but if you're building in a way that could become $1 billion company within whatever it is, like you're a Singaporean or a diaspora person building for the US market, there's a US type of style return. Or maybe you just found something that was really lucky, right? Maybe something unlocks that at a fundamental makes sense. Or you have a bunch of hidden advantage, right? You have regulatory advantage, you have network advantage, you have capital advantage that most people don't have. So you want to push that faster than an organic business could get there. Then you should take it. So what I'm trying to say here a little bit is that's why I'm mixed about secondaries at some level, because I think what happens is that I think if every VC becomes very secondaries oriented, then we end up becoming like a momentum, trading game where we're just like, and if you believe that there's fundamental value creation, then it's fine, because basically we're saying we're trading risk reward curves for that is. If it's no value creation, there's no exit, then they call it the sucker's game. Who's left holding the bag, which we saw a lot in retail crypto. Who's the person who understood the least of the company is left holding the highest multiple company, and they can't sell the secondary and they can't exit. So I think what I'm trying to say here is that feels okay tactically because it's what everybody should do, and I think everybody's already doing. I think I'm worried that if we are not disciplined at the board level, helping founders with the fundamental realities of the unit economics and business to get that value creation in, and we let the companies implode because they were left with the bag holder at the end of that thing, we're just honestly screwing over great founders, learn the wrong lesson from the VC. And we've seen that a lot, actually. I think Geeta and I were discussing that in our last podcast, which we also linked to. But we've just seen VCs have a real huge responsibility to up their game, to understand the business, to spend time with the business, and stop reading Substack or YC videos and then repurposing and repackaging it. Old wine, old expensive wine in an Asian bottle. But then, and then it doesn't work and the companies explode, and then the VC or principal or the partner just exits the VC and joins some other company. I mean, the consequences are on the founder, it's on the employee, it's on the jobs, on the suppliers. I feel like VCs have a real responsibility, because the ability for us, like what we're doing, to discuss this, pattern match, have the real frank conversation within ourselves, and have the real frank conversations with the founders, right? So I think the VCs have real responsibility that I feel like, personally, I don't think VCs are really stepping up to that thing, because it's not just the secondaries game, but it's about the value creation game. Otherwise, we're just destroying the ecosystem at some level. Because then at some level, every American VC that's late stage is going to be like, okay, I thought Southeast Asia multiples were cheap, and so I was going to pay a multiple that's lower than America, but higher than Southeast Asia. But it turns out it was a badly run board, or the accounting was shit, or there was fraud. And so I'm not ever going to do it again, because I'm going to lose my face and I'm going to not be able to be promoted or generate returns for my pension fund or for my hospital system, or generate funds for my endowment fund for the university. So I think there's a certain amount of real politic around that we're talking about, but I think that's where I think the VCs really step out of the game. And I think the reason why I think you and I enjoy talking about this is because we want to be super honest, because we both have builder experience and we both have VC experience. And so I think for the founders is, hopefully you listen to this podcast or you listen to other people who are really honest. I think obviously I recommend Geeta. She's super honest. Shiyan is also super honest. Wing's also super obvious, and they're all co-hosts of the pod. But they're all honest in their own way. So Shiyan's doing a global fund.
Yeah.
She's not doing just Southeast Asia.
Yeah.
And so she's picky, but she's also very direct with feedback, which a lot of people like. I personally like, but a lot of people don't like it because they're like, oh, this is too pessimistic. Wing also does actually this, right? His portfolio selection is actually quite interesting. That reflects, I think, his American perspective, but also his understanding of some of the ecosystem pickups that he can make from Bangkok. And then you also see that for Gita as well, right? She's very frank and thoughtful about the local economics of the business because she was a former founder and operator as well. And so I think that's my fundamental, obviously solution one is be super honest. Everybody's be super honest. Then number two, of course, is be thoughtful and wise about your capital efficiency, therefore your growth strategy, be super disciplined with your strategy, and therefore be very disciplined about your fundraising strategy because you have to understand the Series B cliff / floor that's happening. And I think the third that's really key for me is I think secondaries is a subset of creating immediate value because there's no other way to do it. But I just don't want to see the whole game to be secondary trading. I really think if I was to say is if there's a very strong community, I really hope that Brave is that community, hopefully, is that really focus on discipline, capital, execution, value creation, because we understood those two things. We're honest with one another earlier, and because we understand that the market is tough. What I'm trying to say here is that, and I think sometimes people tell me, I say, hey, Jeremy, are you being pessimistic? Or you don't like the ecosystem? I'm like, no, I'm a patriot. I came back from the US ecosystem, and I said, I'm not going to maximize my career and my enterprise value in SF or New York because I can maximize if the fundamental ecosystem and the fundamental industry is growing a certain thing, even though it's bull and bear market, there's a higher EV, right? You know what I mean? So I'm a patriot for Southeast Asia, but I'm not saying that I don't like the ecosystem. I'm just saying that we're early. It will get better if we're honest, if we're disciplined, and if we're focused on value creation. But if we're honest, we're disciplined, and we're all focused on trading to one another, effectively in a shell game to be like, oh, who's a sucker? Oh, I sold that guy at 20x multiple and I bought it at 3x multiple. Then you're just like, you didn't create value, right? I mean, okay, technically you did create value because you believe in the founder before anybody else, but still you didn't. I mean, that's not why you got in. Then, or if we are like, we lie to one another, we're disciplined and we create value, then a lot of people get burned. If we're honest, we try to do value creation, but we're not disciplined at all because we spend like drunken sailors, then we're also not going to get there. And so I think the ecosystem has to have that Darwinian hope and obviously aspirational approach to be like, I think you need to be all three things, be honest, value creation, and discipline, which I think is actually kind of our community values for Brave, funnily enough. But I think that's how I think about it.
And I think with that, we have come to the end of the Jeremy and Adriel breakfast show. Forward to the next one. It's been a real pleasure to talk through like the sort of like reflections about Southeast Asia venture capital over the last 10 years, the sort of reverse economic arbitrage of hiring expensive talent, the sort of like realistic exit outcomes you can expect, i.e. 100, 250 mil M&As or even IPOs rather than your multi-billion dollar IPOs in the US, to even things like fund strategy, deployment, using leverage, secondaries. Yeah.
Awesome. Thanks, Adriel. Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.